Hi everyone, welcome back to the Investing Iguana, where we share tips and tricks on how to grow your wealth with smart investing. I'm AD, your friendly guide to the world of finance. In today's video, I'm going to show you how to spot undervalued Singapore stocks like a pro. What are undervalued stocks, you may ask? Well, they are stocks that are trading below their true or intrinsic value. In other words, they are bargains that you can buy at a discount and sell at a profit later. Sounds good, right? But how do you find these hidden gems in the stock market? That's what we're going to explore in this video. Before we begin, please remember that this video is for educational and entertainment purposes only. It is not financial advice, and you should always do your own research before investing in any stocks. Also, if you enjoy this video, please hit the like button and subscribe to our channel for more investing content. And don't forget to turn on the notification bell so you won't miss any of our future videos. Alright, let's get started. Here are 5 tips to spot undervalued Singapore stocks like a pro. Tip number 1, use financial ratios. One of the simplest ways to identify undervalued stocks is to use financial ratios. These are numbers that measure the performance and valuation of a company based on its financial statements. Some of the most common ratios that investors use are price to earnings, PE ratio. This measures how much you are paying for each dollar of earnings that a company generates. A low PE ratio means that the stock is cheap relative to its earnings potential. Price to book, PB ratio. This measures how much you are paying for each dollar of assets that a company owns. A low PB ratio means that the stock is cheap relative to its net worth. Dividend yield. This measures how much income you are getting from owning a stock. A high dividend yield means that the stock is paying out a large portion of its earnings as dividends. You can use these ratios to compare different stocks in the same industry or sector and find out which ones are undervalued. For example, if you want to invest in Singapore's real estate sector, you can look at the P/B ratios of different real estate investment trusts, REITs, and see which ones are trading below their book value. You can also look at their dividend yields and see which ones are offering attractive payouts. Of course, you should not rely on these ratios alone. They are only indicators and not guarantees of value. You should also consider other factors such as the growth prospects, competitive advantages, and risks of each company before making a decision. Tip number 2, use discounted cash flow analysis. Another way to find undervalued stocks is to use discounted cash flow, DCF, analysis. This is a more advanced and sophisticated method that involves estimating the future cash flows of a company and then discounting them back to their present value using an appropriate rate of return. The result is the intrinsic value of the stock, which you can then compare with its market price. To perform a DCF analysis, you need to follow 3 steps. Step 1, estimate the future cash flows of the company for a certain period of time, usually 5 or 10 years. You can base your estimates on the historical performance, growth rates, margins, and capital expenditures of the company. Step 2, calculate the present value of each future cash flow using a discount rate that reflects the risk and opportunity cost of investing in the stock. You can use the weighted average cost of capital, WACC, or the required rate of return, RRR, as your discount rate. Step 3, sum up the present values of all future cash flows to get the intrinsic value of the stock. For example, let's say you want to find the intrinsic value of RoboBasketball, a fictional company that makes a remote-controlled drone that looks like a basketball. You look at its current cash flow statement and see that it generated cash flow of $100 million over the last 12 months. Based on the company's growth prospects, you estimate that RoboBasketball's cash flow will grow by 5% annually for the next 10 years. If you use a discount rate of 4%, the intrinsic value of RoboBasketball would be a little over $2.8 billion using discounted cash flows. The advantage of using DCF analysis is that it captures the true value of a company based on its ability to generate cash over time. However, it also has some drawbacks. First, it requires a lot of assumptions and projections that may not be accurate or realistic. Second, it is sensitive to changes in the discount rate and growth rate, which can significantly affect the final result. Third, it does not account for other factors such as market conditions, competitive forces, and intangible assets that may influence the value of a company. Therefore, you should use DCF analysis with caution and cross-check your results with other methods and sources of information. Tip number 3, use asset-based valuation. The simplest way of calculating the intrinsic value of a stock is to use an asset-based valuation. The formula for this calculation is straightforward. Intrinsic value equals sum of a company's assets, both tangible and intangible, sum of a company's liabilities. This method assumes that the value of a company is equal to the value of its assets minus the value of its liabilities. In other words, it is what you would get if you sold all the assets and paid off all the debts of the company. For example, let's say you want to find the intrinsic value of Jardine Matheson Holdings, a conglomerate that owns businesses in various sectors such as retail, property, engineering, and automotive. You look at its balance sheet and see that it has total assets of $64.6 billion and total liabilities of $30.9 billion. Using asset-based valuation, the intrinsic value of Jardine Matheson Holdings would be $33.7 billion. The advantage of using asset-based valuation is that it is simple and easy to understand. However, it also has some limitations. First, it may not reflect the true value of a company's assets, especially if they are intangible or hard to measure. Second, it may not capture the earning potential or growth prospects of a company's assets, which may be higher or lower than their book value. Third, it may not account for the synergies or economies of scale that a company may enjoy from owning multiple businesses. Therefore, you should use asset-based valuation as a rough estimate and supplement it with other methods and sources of information. Tip number 4, use relative valuation. Another way to find undervalued stocks is to use relative valuation. This is a method that compares the valuation of a stock with the valuation of similar stocks in the same industry or sector. The idea is to find stocks that are trading at a lower multiple than their peers, which may indicate that they are undervalued. To use relative valuation, you need to follow 2 steps. Choose a valuation metric that is relevant and consistent for the industry or sector that you are analyzing. Some of the common metrics that investors use are P/E ratio, P/B ratio, P/S ratio, price to sales, P/CF ratio, price to cash flow, EV/EBITDA ratio, enterprise value to earnings before interest, taxes, depreciation, and amortization, and ROE, return on equity. Compare the valuation metric of the stock that you are interested in with the average or median valuation metric of its peers. If the stock has a lower multiple than its peers, it may be undervalued. If it has a higher multiple than its peers, it may be overvalued. For example, let's say you want to find undervalued stocks in Singapore's consumer goods sector. You decide to use the P/E ratio as your valuation metric. You look at the average P/E ratio of the sector and see that it is 15. You then look at the P/E ratios of some individual stocks in the sector and see that Wilmar International has a P/E ratio of 7.5, Dairy Farm International has a P/E ratio of 14.3, and Thai Beverage has a P/E ratio of 18.7. Using relative valuation, you can conclude that Wilmar International is undervalued compared to its peers, Dairy Farm International is fairly valued compared to its peers, and Thai Beverage is overvalued compared to its peers. The advantage of using relative valuation is that it is simple and intuitive. It allows you to quickly screen for stocks that are cheap or expensive based on their industry or sector standards. However, it also has some drawbacks. First, it may not reflect the true value of a stock, especially if the entire industry or sector is overvalued or undervalued by the market. Second, it may not account for the differences in quality, growth, risk, and profitability among different stocks within the same industry or sector. Third, it may not consider other factors such as market sentiment, competitive advantages, and future prospects that may influence the value of a stock. Tip number 5, use qualitative analysis. The last tip to spot undervalued stocks is to use qualitative analysis. This is a method that involves evaluating the non-financial aspects of a company, such as its business model, competitive advantage, growth potential, industry trends, customer loyalty, brand recognition, innovation capability, management quality, corporate governance, social responsibility, and environmental impact. To use qualitative analysis, you need to follow 3 steps. Gather information about the company from various sources, such as its website, annual reports, press releases, news articles. Analyze the information using various frameworks such as SWOT analysis, strengths, weaknesses, opportunities, threats, Porter's 5 forces analysis, industry rivalry, bargaining power of suppliers, bargaining power of customers, threat of new entrants, threat of substitutes, and Pastel analysis, political, economic, social, technological, environmental, legal factors. Evaluate the information using various criteria such as value proposition, competitive edge, growth drivers, industry outlook, customer satisfaction, brand equity, innovation potential, management competence, corporate culture, ethical standards, and environmental performance. For example, let's say you want to find undervalued stocks in Singapore's technology sector. You decide to use qualitative analysis to assess the company Sea Limited, which operates 3 platforms: Shopee, e-commerce, Garena, gaming, and Sea Money, digital payments. You gather information about the company from various sources and analyze it using various frameworks and criteria. You find out that Sea Limited has a strong value proposition as it offers a diversified portfolio of services that cater to the needs and preferences of Southeast Asian consumers. It has a competitive edge as it leverages its local knowledge, network effects, and user engagement to create a loyal customer base and a vibrant ecosystem. It has growth drivers such as increasing internet penetration, rising disposable income, and growing demand for online shopping, gaming, and payments in the region. It has a positive industry outlook as it operates in fast-growing and high-potential markets that have low competition and high barriers to entry. It has high customer satisfaction as it provides a seamless and convenient user experience across its platforms. It has strong brand equity as it is recognized as a leading and trusted player in the region. It has high innovation potential as it invests heavily in research and development and adopts cutting-edge technologies such as artificial intelligence, big data, and cloud computing. It has competent management as it is led by a visionary founder and CEO who has a clear strategy and execution. It has a positive corporate culture as it fosters a culture of innovation, collaboration, and excellence among its employees. It has high ethical standards as it complies with local laws and regulations and respects the privacy and security of its users. It has good environmental performance as it minimizes its carbon footprint and supports green initiatives. The advantage of using qualitative analysis is that it captures the intangible and qualitative aspects of a company that may not be reflected in its financial statements or ratios. It allows you to assess the quality, potential, and sustainability of a company's business model and competitive advantage. However, it also has some challenges. First, it may be subjective and biased depending on the source and interpretation of the information. Second, it may be difficult and time-consuming to gather and analyze the information from various sources. Third, it may not be comparable or consistent across different companies or industries. Therefore, you should use qualitative analysis with an open mind and critical thinking and balance it with other methods and sources of information. So there you have it, 5 tips to spot undervalued Singapore stocks like a pro. I hope you found this video helpful and informative. If you did, please give it a thumbs up and share it with your friends. And if you have any questions or comments, please leave them below. I'd love to hear from you. Thank you for watching the Investing Iguana. I'm Iggy, signing off for now. See you in the next video. Happy investing!